Greetings, Jonathan Camarda, Chief Investment Officer. Hopefully you're all doing well. So a lot to cover, so we'll get right to it. The market is at an interesting juxtaposition here. As you may have noted a couple of weeks ago, we noted that we took some of our gains from the summer off the table in anticipation of pretty strong resistance at the 200-day moving average for most of the indices here, the Dow, NASDAQ, as well as the S&P 500. And we're starting to see some of that resistance come into play where the market is pulling back. Now, it could be just a consolidation within a new spring bull run, or it could be what many think, the ending of a short summer party, if you will, for the bulls in a more of a secular bear market. And that's still to be determined. We're not going to call that here right now, as we do have to let the charts and the macro data really bear that out. Now, the one thing I'll say as we turn to macro, very interesting piece that I read in the Wall Street Journal earlier this week, where the Fed, we all love the Fed, right? That there's some internal consternation apparently about the recent run in the market, that I guess that the market participants just haven't had enough of a beating this year because the recent run up has caused some of the hawks to think that, again, that they need to really douse any enthusiasm or optimism out of the market so its work can be done to get the stickiness, as it were, of inflation out of the system. Pretty interesting, just the way it was worded. That's how I took it. Pretty interesting. So keep that in mind, because we really are looking at somewhat of a coin flip on the next meeting, right? 75 basis point hike. Another one, Bullard. I mean, of course, he'd like 100 basis points, right? And then 50 basis points, many still think. And the reason why 50 basis points is on the table is if you look at the economic data. We are officially in a recession. They may deny it, but the numbers, as we talked about a couple months ago in projecting, we've had 2 straight negative GDP quarters. That is a recession defined. And you notice the yield curve has basically proven so. Long end yields were lower and have been lower than short end yields, as many inversions have occurred this summer, which is recessionary. But even on top of that, the bond market, right? They're always the chess players. Now you're starting to see, we already saw it in inventories, right, early in the spring, and they continue to pile up, by the way, in retail stores, regardless of some of the good news that we've had at some of the big box stores. Inventories are still piling up. And if you look at the housing market, before the increase, especially in the short term end rates, were what was causing some consternation in the housing market, but supply was so scarce, it was buoying, right, the overall prices. Now, however, we're starting to see supply increase. So the supply-demand dynamics are starting to normalize, which is now starting, as we look at house and home prices, drop. So that's something we have to keep an eye on. Now, some of you in our sector rotation strategy know that we've taken advantage of it and made some nice tidy little gains there in the home building market, but that party may be coming to an end. Stay tuned and as such. Now, hasn't been much trading this week, but one thing that you will see as we move into the weekend, into next week, is a reinsertion of the energy play, as the energy markets have just really had a positive burst technically with 8 and 21-day moving averages moving over 50-day moving averages and as such. Not to get too quantitatively technical on you, but that really speaks to the increasing rates that we're starting to see on the short end, right? The thought of the Fed increasing rates, and then also, as we kind of shuffle to currencies, is King Dollar. I mean, that crown just keeps getting bigger and shinier as the euro has been stomped on in the European economies, the markets, which we have very little exposure to, and the currencies has just been miserable this year. Now, the strong dollar presents a problem in many ways for large multinational companies, think Johnson & Johnson, Nike, and the such, that export a lot of their goods to other countries, right? Because foreign currencies are not priced as high as the dollar on a relative basis. It's more expensive to buy those goods, thus affecting the income statement and balance sheets of these large companies. So again, we are cognizant of that, and we have seen stronger runs in mid and small caps in many cases because of this. Now, with that being said, the strong dollar also portends again of rising short-term yields, and money starts to flow into our country from other countries seeking higher rates, and the currency continues to get stronger. Now, the problem with that is the strong dollar has been negatively correlated with upward moving stock prices, which in English means a strong dollar could prove again to create another leg down in this bear rally after a nice little bull party that we've had. So what are we going to do about it, right? That's probably what you're asking, so we'll get to that here. Well, as you notice, we increased our cash and money market exposure. We've had some hedges on a couple weeks ago in anticipation of this. And of course, we still have some longs now. So obviously on these days, we'll still be down because the market has still structurally in a short-term uptrend. So we want to make sure that that is officially closed before battening down the hatches. However, we will continue to be diligent and eternally vigilant again in assessing where we're going, as if we do hit another leg to the downtrend, you will see a lot of closing of long positions, perhaps some strategic shorts across the board in your macro and sector strategies, as well as global macro and velocity raptor, and of course your opportunistic growth in income and active capital preservation, generally more conservative, but maybe make some transitions as well. So again, what we're seeing is potentially a handoff of the baton back to energy from technology after a brief reprieve this summer. That's not confirmed completely yet, although energy is starting to break out. Technology, a few companies I won't mention right now that I'm watching to see if we have some crossovers to the negative side. That could be the final bell before the party is officially over for technologies. On that note, hopefully you have a great weekend. It's always a pleasure. We appreciate your time, your patience, and most importantly, your trust. Jonathan Camarda, stay frosty.